Good morning. I just wanted to answer some questions about forbearance and what that means, what the impacts are. My name's Kayla Nebeker. I'm a real estate agent here in the Temecula Valley. I've been in this industry since 2005. I work with Realty One Group Southwest in Temecula. And I just have had a lot of questions or concerns about what that means, what would be the impact, what forbearance impact would be on credit scores. And so I just want to give you just a basic outline and then tell you what the red flags are, what the things are to watch out about, because there's a cost to everything. Nothing in this world is free, and this 100% is the case. So sit through this. I know that they can be a little bit long, but have a little bit of patience with me because there's some really important information here that I think is really valuable. I do have several friends who are struggling with trying to keep businesses afloat and trying to figure out how to, manage their mortgage payment along with that. So I just want to make this really clear so that you know what the cost is going to be to you if you take advantage of this forbearance. So what is forbearance? It's a fairly common thing in the lending industry when mortgage lenders have a borrower who gets in a situation where they can't make their payment. The lender will often make accommodations for them to allow them a period of time where they don't make their house payment. So let's say you lose your job or you have an illness and it's a temporary situation. Within the next few months you'll be back on your feet and be able to make your payment again. You would just stop making your mortgage payment, and then when you get back to the point where you can afford to make your mortgage payment again and you're back on your feet, your lender will work with you on how to remedy that, how to bring your loan current. So you may have 3 or 6 months worth of house payments that you have to make up in some way. And there's a lot of different ways they do that. The first one, which would be the first choice of lenders, is a balloon payment. That's just a lump sum payment that you bring your loan current. And sometimes that's required to get out of, if you've had a notice of default or you're in a foreclosure situation, that balloon payment is necessary in order to keep it from being foreclosed on. But this is a whole different animal. Now that the government has required lenders to allow you to do this, it's very unlikely that they're going to require balloon payments from buyers. And there is kind of this misconception that if you have a lot of equity in your house, the lender might foreclose on your property, and it's just not something. Lenders are in the business. They're not in the business of foreclosing and taking back properties. It just does not benefit them in any way. Typically, a foreclosure can take 6 months to 12 months, depending on the complexity of the case. But it costs on average lenders about $50,000 to $70,000 to foreclose on a property. So it's just not something they want to do. And they're going to make every effort to accommodate you. But keep in mind that lenders are in the business of making money. Anything they do is going to be geared toward profiting, and this is no exception. So even though the government has required that they allow their borrowers to go 6 months or more, this stipulation actually grants an additional 6 months too. So if you need 12 months, you can get 12 months where you don't make a house payment. But the government hasn't directed lenders on how they're supposed to remedy that after the 6 months. They have given us some really specific rules, and I want to go through those with you. So part of this CARE Act is that the lender has to allow you either 6 months or up to 12 months, so 2 different periods. It can be extended, where you don't make your house payment. During that time, you cannot, it can't affect your credit score. So they can't negatively impact your credit score for taking advantage of that forbearance. It cannot involve additional penalties, late fees, or an increase in interest rate because you took advantage of that forbearance. So those 3 things are really beneficial, that you have an extended period of time to make no payment, that it can't lower your credit score, that you won't have extra penalties or additional interest for not making those payments. But there are some issues with doing that, and this is where the gray area is, and we just got some new direction this week from Fannie Mae and Freddie Mac about how this is going to affect your credit. So the biggest concern initially is how you're going to pay it back. So that's going to be completely up to the lenders, and they're going to come up with a whole bunch of different plans on how to do that. You know, probably the least popular would be the balloon payment. Most people aren't going to be able to do that, so that's very unlikely. They can do several different ways of paying that back that include either breaking it up into smaller payments and extending it 6, 12, 18, or 24 months. So let's say you went 6 months without making your house payment, and your house payment was $1,800 a month. Then let's say at the end of that 6 months, you start making your house payment again. They're going to add an additional maybe $900 a month to your house payment for the next year until you make up that 6 months worth of house payments and interest that you didn't make during that forbearance period. So that's one way they do it. Another way is they can extend your loan period, and this is actually the most desirable for buyers, for, you know, all the way around would be the best case scenario. Is if your lender, you go 6 months without making your payment and maybe you have 23 years left on your mortgage, then at the end of that 6 month period, they extend it for an additional 6 months at the end of your mortgage. So at the end of that 23 years, you'd have an additional 6 months to pay. But most lenders are going to look for the most profitable way for them to come out of this. And typically that's going to be, they're going to want to refinance your loan. And when I say refinance, that doesn't mean necessarily they're going to charge you all the fees that would normally be associated with a refinance. It may not even mean that they change your interest rate, but usually they're going to change the terms of your loan. So when you get to the end of that forbearance and you're at the point where you can make your house payment again, typically they're going to want to refinance the loan, and basically it starts the clock over. And what that'll usually do is, even though you're adding that 6 months of payments back into your principal, it's going to lower your payment amount. And this is what you need to be aware of. I'm shocked at how many people don't get this or don't understand it when they refi to take cash out. Let's say you've been paying on your mortgage for 8 years or 10 years and you have a 30-year mortgage, and you want to take some cash out, or you need this forbearance added back into your principal, and they refi. Every time they refinance the loan, they start the time clock over. So your 30 years starts all over again. So instead of having if you were 8 years into your mortgage, instead of having your house paid off in 22 years, now it's going to be 30 years before your house is paid off. And your house payment might be slightly lower than it was before. It might be the same as it was before. But your thought is, if I don't have to make that 6 months worth of payments right now in one lump sum, that's great. Your big concern is that your house payment doesn't go up. So just be aware that there is always a cost to you if you do this. If you do this forbearance, that gets added on to the end of your loan. Your loan gets refinanced, the loan term gets extended. A lot of lenders even extending to a 40-year mortgage. So they may keep your interest rate the same. They may add that principal back in. They may make your payment slightly less than it was before, but instead of a 30-year mortgage, now you're in a 40-year mortgage. So, and the lender is going to be the one that dictates those terms, because you're not going to be in a position. Very few people who are having to take advantage of this forbearance are in a position to pay a lump sum and pay it all back all at once. So you're going to have to take the terms they offer you, and whatever those terms are going to be, I guarantee you they are going to be something that profits the lender and costs you. So I know that I have friends, and I have so much compassion for what's going on right now, that people who are losing their businesses. I have a good friend who had to close down a business that I know was literally her whole heart and soul, and that just breaks my heart. So I understand if you are one of those people who your business is your livelihood and that has been cut off, and you are in need of this forbearance to be able to stay in your home, definitely take advantage of this. But if you're one of those people who I've listened to recently who are just considering strategically using this forbearance to take those funds and maybe pay off other debts or do other things, I think in the long run, you're going to be sorry. But the biggest reason, and this is the one takeaway, and I hope you've hung out through this video to hear this, because this is the one takeaway you need to take from this. We just got word from Fannie Mae and Freddie Mac that there's a new overlay on their loan qualifying criteria. And when I say overlay, it's not a specific I'm going to try to make this super, super simple. So the way lending works right now in our country, about 80% of loans are funded and meet the criteria through direct private or institutional lending organizations that sell their loans to federally backed mortgage investors. So Fannie Mae and Freddie Mac are the biggest mortgage investors in our country. And so what happens is your lender lends you the money for your house and you start making your payments to them. And within a certain period of time, they bundle your loan with a bunch of other loans that meet all that same criteria and they sell them off. And as long as they meet those Fannie Mae or Freddie Mac criteria, they can be bought by, mutual funds and any type of mortgage-backed securities that go into they're basically investments for people. But this is what just came out this week. So even though taking advantage of this forbearance does not affect your credit score, there is a new requirement that if you're going to get a conventional loan, so something that's backed by Fannie Mae or Freddie Mac, if it's a conventional loan, which is about 80% of the loans in our country, and you're going to refinance or you're going to purchase, you cannot get one of those loans if you've been in forbearance within the past 12 months. So it is going to be reported on your credit, not to affect your credit score, but just to show that you're in forbearance or you have been in forbearance and what that period of time was. And going forward, we don't know how that's going to affect you. I mean, right now, there are lenders, they'll ask you, have you ever filed bankruptcy? There are some lenders that won't lend to you if you've ever filed bankruptcy. I mean, obviously, there's a time period on those kinds of things for how long it stays on your credit report, but it affects your financial fitness, I guess, is what it is. And so even though it doesn't affect your credit score, it does affect your qualifying ability for different types of funding and for even different types of security clearance. So anything that would show your financial fitness. Even employers who run credit reports will be able to look at that, and that will be a question that may be asked on employment interview questions when people do background checks. Have you ever filed bankruptcy? Have you ever used forbearance? So if those issues are things that you think may affect you, if you're a financial counselor, an investment advisor, if you are working anywhere in the banking industry, it may affect your ability even for employment. So just be aware of that if you are considering forbearance and want to take advantage of that for any type of strategic reason, just keep in mind that it will affect your ability to take out a purchase or refinance loan on a conventional property. Again, this isn't FHA, it's conventional, but those are the majority of the loans in our country. So it's going to affect your ability to qualify for those loans for at least 12 months, and going forward that could change. And it will also show up on background checks and could be a qualifying factor for employment interviews. So just keep those things in mind. I really, there are so many unknowns about what's going on with all the changes that are happening right now. And I would say err on the side of caution. Don't ever just jump on something like that thinking, oh, I can just not make my house payment and use those funds elsewhere for right now. If you have the means to make your house payment, definitely do it, because it will come back and bite you in the butt. There are too many factors that play into this, and it's important to be aware of those. So I'm happy to share any information I have. I hope that helps you guys in some way just to understand what this is all about. If you have questions about real estate or about mortgage lending, I'm happy to answer your questions. I do a lot of research online, and I'm closely connected with some economists and local lenders that I want to stay really current on what's going on. So I'm happy to answer any questions that you may have. Give me a call. My name again is Kayla Nebaker. I'm with Realty One Group Southwest in Temecula, and my phone number is 951-375-6373. Look forward to hearing from you.